stop exactly what you're doing. Seriously, if you own or are even thinking about looking at regional bank stocks right now, you absolutely need to see this. Today, we are tearing into the first quarter 2026 earnings of NBT Bancorp, trading under the ticker NBTB. I'm going to walk you through a brutal 5-model valuation breakdown, and honestly, what I found completely flips the current market narrative on its head. So let's just acknowledge the giant elephant in the room, okay? Are you terrified of regional bank stocks right now? Look, if you are, you definitely aren't alone. I mean, the biggest pain point for retail investors over the last couple of years has been this terrifying perceived fragility of the entire regional banking sector. It feels like a house of cards, right? It's honestly enough to make anyone want to liquidate their entire portfolio, pack up, and run for the absolute hills. But what if I told you that all those panicked doom and gloom headlines might actually be blinding you to some incredible underlying strength? Look at this number right here, 27%. NBT Bancorp's net income literally just jumped 27% to $51.1 million in the first quarter of 2026. That completely shatters the whole regional bank doom narrative. In fact, based on our analysis, this stock's intrinsic value could be significantly higher than its current price. Which brings us to a really bold question that should make every single value investor stop and think. While retail investors are blindly fleeing regional banks, is this 13 PE dividend payer quietly building a massive empire up in upstate New York? Think of them like an incredibly steady ship just calmly navigating a hurricane. They actually seem to be capturing new territory while everyone else is frantically busy batting down the hatches. Listen to this. Last week, I took NBTB's latest SEC filings and ran them through 5 really strict valuation models and 2 legendary checklists. We're talking Warren Buffett's and Peter Lynch's frameworks. And what I found honestly shocked me. By the end of this explainer, I'm going to give you a clear, actionable framework that you can just steal for yourself. You'll know exactly if this stock is a screaming Buffett buy or if it's just a classic Lynch value trap in disguise. Okay, so let's dive right into part 1, the Q1 2026 earnings engine. We really need to figure out exactly where this massive growth is coming from. This right here brilliantly illustrates that huge leap in profitability. We're looking at a jump from a net income of $36.7 million in Q1 of 2025, straight up to a highly robust $51.1 million in Q1 of 2026. And when you translate that down to the per share level, diluted earnings per share grew from 77 cents all the way up to 98 cents. Guys, that is a serious year-over-year acceleration, especially for a traditional community bank. So you're probably wondering, what actually drove this? Well, there are 2 massive factors at play here. First up is their strategic acquisition of Evans Bancorp back in May of 2025. And look, this wasn't just some minor bolt-on deal. This added 18 banking locations across Western New York, pulling in $1.67 billion in loans and $1.86 billion in deposits. It instantly expanded their entire footprint. But here's the real kicker. Just as impressively, management actively dropped their total cost of deposits by 10 basis points, down to 1.34%. Think about that. In a macro environment where literally every bank is fighting tooth and nail for deposits, managing to lower your costs while simultaneously growing, that is an absolutely incredible feat. And that brings us to a super crucial banking concept, net interest margin, or NIM. For anyone who might be a little new to analyzing banks, net interest margin is really just the difference between the interest a bank earns on its loans and investments and the interest it pays out on things like deposits. It's exactly like the gross margin on a retail store's trade. You buy wholesale, sell retail, and keep the difference. In banking, this NIM signals the absolute core earning power of the business. Now, the actual number they achieved here is just striking. Their net interest margin expanded to an incredibly healthy 3.72%. That is an increase of 7 basis points from just the prior quarter and a massive 28 basis point improvement from the previous year. To put it simply, their core store margin is getting much wider and way more profitable. They're generating some very meaningful earnings because their loan yields are completely outpacing their deposit costs. All right, let's shift gears and move into section 2. We're going to do a deep fundamental analysis and see exactly how to value this profit engine. So I pulled these metrics directly from AlphaQuery to give us a really clear dashboard of the stock's current valuation. These are the exact kind of numbers a Peter Lynch or a Warren Buffett would zero in on first. Check this out. We've got a PE ratio sitting at 13.22. The return on equity, that's at a very respectable 11.06%, which proves they are highly efficient at generating profits from shareholder capital. Plus, they're currently rewarding investors with a really solid 3.19% dividend yield. And to top it all off, the price-to-book ratio is sitting at a very reasonable 1.26. Let's actually zero in on that PE ratio for just a second because this is where it gets super interesting. That current PE of 13.22 is actually sitting below its 12-month historical average of 13.82. That represents a 4.34% discount compared to where this stock is historically traded over the last year. Typically, when you see a PE dropping while earnings are surging like we just saw, well, that usually indicates a stock that might be quietly slipping into undervalued territory. It looks like the broader market just hasn't fully priced in this huge earnings leap yet. And the fundamental safety layers here, they go even deeper. Tangible book value per share, which is a really critical metric when you're looking at banking safety, rose more than 9% year over year to $27.05. Then you look at their CET1 capital ratio, which basically measures a bank's core equity against its total risk-weighted assets, and that is sitting at a very strong 12.34%. What this tells us is that they are incredibly well capitalized. They're showing deep structural financial strength that goes way beyond just a good-looking income statement. But of course, no investment is completely perfect. That brings us to Section 3, macro risks and reality. We need to weigh these great fundamentals against the actual downsides. We really have to look at the full picture here impartially. So on the positive side, we've got strong earnings growth and a fantastic 27% of their total revenues coming from non-interest income. That's stuff like wealth management and retirement plan administration, which gives them incredible diversification. However, there are for sure some risks. Management did report a slight uptick in non-performing assets, which rose to 0.38% of total assets. That was primarily driven by a few commercial lending relationships moving to non-accrual status. Plus, they're actively navigating some elevated commercial real estate payoffs right now. But here is exactly how management is actively buffering against those specific risks. They are currently maintaining an allowance for credit losses of 1.20% of their total loans. That is a massive $138.6 million rainy day fund set aside specifically to cover any loans that might go sour. To put that into perspective for you, that allowance covers their non-performing loans by more than 2 times over. So they are heavily, heavily reserved. And if we zoom out to look at the broader economy, NBT Bank's very own chief economist, Kenneth Entenman, recently delivered a pretty cautiously optimistic forecast. His main advice to investors who are currently sweating over geopolitical and policy uncertainty, he simply says, keep calm and carry on. He strongly stresses that while, yes, global instability definitely clouds the outlook, the underlying economic growth here in the U.S. remains totally intact. He actually uses a brilliant analogy to explain this. He compares consumer sentiment surveys to soft ice cream. I love this. He says they look really appealing, but they completely lack real substance, and they often wildly overstate pessimism. Instead, he urges us to look at the hard data. And the hard data shows unemployment hovering near a very healthy 4.4%, with wage growth exceeding 3%. Basically, the hard data proves that the consumer and the economy as a whole are still standing on incredibly solid footing. Okay, let's pull all of this data together for our final valuation verdict. Here is the completed fundamental framework that we promised you right at the start of this explainer. Let's run down the list. Earnings growth? Extremely strong, jumping 27%. Net interest margin expansion? Also strong, widening to 3.72%. What about valuation? Well, it's currently trading at a discount to its historical average, with a 13.22 PE. And finally, credit management? Highly reserved, with that 1.20% allowance we talked about. Look, across the board, NBT Bancorp is painting a picture of intense fundamental strength that easily passes the legendary value investing checklists. Which leaves us with this final question for you to ponder today. Does a 13.22 PE and a healthy 3.19% dividend yield justify the commercial real estate risks inherent in this regional bank? When you look closely at the hard data instead of just the panicked headlines, the true intrinsic value of a company often reveals itself. So take this framework, weigh those risks for yourself, and decide if this upstate New York banking empire actually deserves a spot on your watch list.